No, it says recording. That's great.
Awesome. Yeah, here we go.
Hey y'all, good evening. Can everybody hear me okay? Thumbs up.
Oh, we don't see anybody, and everybody's on mute.
I see some people
Wayne?
popping up.
I see some smiling faces. Yeah,
Okay.
yeah. Some
All
Oh, I
thumbs
right.
got a
up.
thumbs up. All right,
Yep.
cool.
Woohoo!
All right, we got a thumbs up. We can rock and roll.
Glad y'all are able to join us. We are fortunate today, since I'm here, I'll do a brief introduction. I don't like to take a lot of time on the front end because it takes away from the program and the real reason everyone came. But just want to say thank you for joining us this evening. Nick, thank you for joining us and giving us this information. Hurricane Helene tax considerations for farm business owners. This is done obviously in collaboration with the AB Tech Small Business Center and Empowering Mountain Food Systems. Laura, thank you. Jennifer, thank you for being here for this program. If you're interested in more programs offered by the AB Tech Small Business Center, probably the best place to start just to find out more about us is our website at abtech.edu/SBC. I can drop that link in the chat if you all are interested. And just keep in mind that we are the Small Business Center Network is a statewide network available to anyone who's looking to start or run a business. And we offer free services. So if you don't remember anything else I say, just remember everything that we do is free to the public. And we're fortunate enough to have these folks here today. And I'll turn it over to you all if you want to say a little bit more about what you do. And then we'll just get into the program.
Awesome. Thanks, Dwayne. Appreciate you setting this teams up and for all of our attendees bearing with us. You know, we're a couple years into the Zoom thing, but it seems like it's always a struggle to get it launched sometimes. But we're here and we're so glad you're joining us this evening to learn about agricultural taxation and how Hurricane Helene may have impacts on that for your farm. Like Dwayne said, this is, hosted in collaboration with AB Tech Small Business Center, Empowering Mountain Food Systems, which is a local food system initiative of SEFS, and North Carolina Cooperative Extension. And to introduce our speaker briefly, I don't want to take away from his thunder, but Nick is a newly appointed professor at NC State. He graduated from UGA and has a background in law as well as, obviously this agricultural business aspect and is teaching agricultural taxation at NC State currently. So we're excited. Laura, Nick, I'll turn it over to y'all so we can get started.
Hey, good evening, everybody. I'm just going to say hello. I'm the project director. I'm based in Jackson County, and we are working in a 12-county region. And really sad we have to be here to talk about Hurricane Helene tax considerations, but I'm glad that Nick is here and able, we hope, to lend a hand. And we're very committed to helping in the rebuilding process, and I hope tonight can help with that. So I'm going to hand it over to Nick, and we are going to take questions in the Q&A. On my menu, the Q&A is at the top of my screen. What we'd like to do is hold questions to the end, but go ahead and put your questions in the Q&A, and we will be sure and get to them. So thank you so much again, Nick, and thank you, Dwayne and Daphne at Small Business Center. We really appreciate this partnership. Okay, Nick, to you.
All right, well, thanks everybody, Dwayne, Jennifer, and Laura. Happy to be here in some sense, but also sad in another sense because of how I was going back through and listening to things that came up on the way doing some commuting today that were posted when Helene came out, and it reminded me of how bad it has been for y'all in the area that y'all live. But this is my first year at NC State. I know Jennifer was trying to hype me up a little bit by saying, I don't want to take up too much of his time, but there's not much to introduce at this point. I started in NC State in August of last year, and they told me sort of that I would have a slow roll into all this, being the tax professor and doing the tax extension work. And I was really excited to be here. I still am excited to be here. But then Helene came through, and I wanted to do whatever I could to be as much of an asset to y'all in using what time that I had. Because obviously y'all have gone through a lot in the past 6-8 months, and I want to provide whatever resources I can to y'all. Before I start, I like to give a disclaimer before I start. That's just the attorney that's still in me. Tax law is very complex. Hopefully I can make it a little bit less complex for y'all this evening, including for those of y'all who are watching this on the recording as well. It often hinges on details that would only become apparent to somebody, a professional, when they had access to your books as well as the rules. I'm happy to answer questions at the end and be as specific as I can be, but just know that true tax advice is going to have to come from a tax professional who's looking at your books at the time. But when I say tax professional, I usually mean an enrolled agent or a CPA. I'm working towards my enrolled agent certification, but for now, I'm just a bar attorney in the state of North Carolina and the tax professor at NC State. And so I try to give the best application of the tax laws as I can see fit. But again, somebody who has access to your books is going to be somebody who I'll direct you to towards more specific questions. And this is one of the situations, this was always going to be true with any of the presentations that I do. It's not tax or legal advice, but especially in a situation as dire as you may be in from Helene, it's really going to be valuable to have a trained and very good CPA or EA look at your books and be able to apply these specialized rules, because this is not, the simplistic tax rules. If Helene did not come through, this would not have been the first thing that I would have been applying research sessions to, but hopefully this can be of some help to y'all. The other note that I want to give based on all this is I do want to be as much of a resource as possible, both towards those who are attending this session live as well as those who are watching the recording. If you have a question for me and I don't answer it here, or if I outright tell you that I don't know the answer, please send me an email. These slides will be posted onto a website that I run. You can see the link to the website at the bottom. If you don't want to write down that link, because I don't think anybody writes down links these days, you can just Google NCSU Farm Law and Tax. I'm doing another presentation in the western part of the state later this week, weather permitting, and I'm going to post an article with all of this information in a more digestible format, as well as questions that come up tonight and on Thursday night. And so hopefully it can be a very good one-stop shop for all your Helene-related tax questions. But if not, my email is always there. It's nwbrown2@ncsu.edu. And so without further ado, we'll get into the presentation. I always like starting out with a roadmap for my presentations. I think it does a good job of compartmentalizing where we're going, and so that you don't just hear me rambling on in about 15 or 20 minutes and think like, how did we even get to this point? And so we're going to start out with some more basic questions. What is the difference between accrual basis and cash basis filing? And the extensions of tax deadlines that have come up as a result of Helene. I meant to put it in there, but I was running out of space. There's extensions of federal tax deadlines and an extension of state tax deadlines, or some nuanced extensions of state tax deadlines. And so make sure to pay out for attention on those. There's also been a lot of talk about property taxes from your local government. So we'll cover those too, as well as the taxability of disaster relief payments. And when I say that, I mean FEMA money, FSA money, or even money come from charitable organizations. That's the kind of taxes that I'm talking about, as well as insurance proceeds, which includes crop insurance proceeds. Then we'll get into some specific issues with the sales of livestock due to weather, timber losses, which covers Christmas tree losses, and a few other things. And we'll top it all off with a lot more specialized resources by people who are the other university versions of me, except 20 years down the road in their career with a lot more expansive presentations than what I have tonight. And so the first thing we'll do, because I really appreciate those who send in questions, and one of the questions was the difference between accrual basis and cash basis. And these are the ways that you determine how your transactions are recorded. When I say transactions, I mean money going in, money going out. So spending money or making money. Most of y'all, and probably 100% of y'all, I would honestly be shocked if it wasn't 100% of y'all, are cash basis filers, meaning that your transactions are recorded when cash is paid or received. So when the money comes into your pocket that's when you've made the money according to the IRS. There's a few exceptions with this, with some disaster relief rules. I'll point those out as they come in. But generally speaking, if you make money on January or February 17th, then you earned that money on February 17th. Whereas accrual basis recognizes the revenue when it's earned and the expenses when they're incurred. And so it's easier to explain this with examples. And so we've got two farmers, one's a cash basis, one's an accrual basis, and they each purchased 10 years worth of fertilizer in 2020. Now, the cash basis farmer, he expenses all 10 years of that fertilizer in 2020. It doesn't matter if he uses 10% of it in 2020, if he uses 100% of it in 2020, he's putting that entire fertilizer purchase in 2020 as a deduction, as an expense. Whereas the accrual basis farmer is putting 10% of that purchase as a deduction or expense in 2020 and another 10% in 2021 and so forth until he hits 0%. Cash basis is a lot simpler. It's the default unless you say otherwise with the IRS. And so most everybody is cash basis. And with most of these rules that we're talking about tonight, that's going to be the prerequisite filing. And so if you're accrual basis, it actually changes your eligibility for a few of these rules. But again, most of y'all are probably cash basis. I just wanted to clear that up as we get into this because it is a prereq for some of these rules. When Hurricane Helene hit, it was around late September. I couldn't remember the specific day that it hit. I didn't remember if it was, I think it was closer towards the 27th, but there were some websites reporting the 25th. And I think the 25th was more when it was striking into Florida. But there were some federal tax deadlines that were coming up along these times. And so October 15th was a pretty big date. If you had an extension for your 2023 taxes, October 15th was likely when they were going to be due, along with some other deadlines that I've got listed there at the bottom. And basically any deadline that was between October 15th and May 1st, 2025, got pushed out to May 1st, 2025. And this is going to have some pretty significant implications. And I want to walk through some things to show you why. Now, before I say that, if you paid off your 2023 taxes in April 2024, on time per se, without getting any extensions, then this doesn't apply to you as much, but it's still worth talking about just in case you're not sure. But if you did have an extension for your 2023 taxes and you had it pushed back to October 15th, May 1st, 2025 is going to be a really big day for you. And so what this extension did was your 2023 tax returns with an extension got pushed to being due May 1st, 2025. Now, the IRS, when they made that extension, realized, well, 2024 taxes are technically due on April 15th, 2025, and we don't want to have 2023 taxes due after 2024. And so they just made both 23 taxes, those with extensions, and 2024 taxes due on the same day. Now, there's some other things that I list here with respect to May or 2023 taxes. If you had some payments, your quarterly payments that were due on January 15th, 2025 or April 30th, 2025, relating to your 2023 taxes, those are also moved towards May 1, 2025. And so May 1 of this year is going to be a very big day. And the reason being, and I don't know if this is blocking y'all's view of this last line there, but I had something blocking my screen there. But the reason being is on May 1, 2025, at the very least, your 2024 tax return is going to be due at the federal level. If you had an extension in 2023 for your 2023 taxes, you may have both years' taxes due on the same day, which could result in a pretty significant tax bill, especially if there's any amendments that had to be made on your 2023 taxes. And so definitely want to flag that date, talk with your CPA or talk with your tax professional about how you handle that, or go back through your records and see how you handle that, because you may end up having a pretty significant tax bill hit on May 1st. And, it's one of those things where you would have paid it, if Helene not hit, you would have paid it in October, and now you're just having to pay it in May instead. But, speaking from personal experience, it's when you have a amount of outflow that's that big, it tends to hit your books. Maybe it's just the emotional side of it, but it tends to hit your books, like your heart, a little bit harder when you have such a large outflow. If you got 2 years taxes going out at the same time, even if you had saved the money and kept it aside. And so it's definitely something to take note of. and go back through, not just to check only your 2024 taxes, but also your 23 taxes as well. And so just keep tabs on that. When I put these slides out there, you'll notice that some of these headlines or these headings it's supposed to be blue. It's still pretty dark, but they're bolded and underlined. And this is actually linked where the IRS talks about other more nuanced taxes that are due on May 1, 2025. The state tax deadlines did not move, at least in North Carolina. And so North Carolina state taxes are still due on April 15th. Now, I say due on April 15th of this year a little bit lightly. There's no penalty that's going to be imposed as long as you file before May 1, and that's applicable to all NC residents. And so essentially what the North Carolina Department of Revenue is doing here is saying, hey, there's probably going to be some taxpayers that see the IRS extension and think, well, I don't have to file anything until May 1. And, they'll wait till April 20th, 25 or 25th and file everything at once. North Carolina is not going to punish you for waiting that long. Now, do you want to wait that long? Probably not, especially if you're here, you're probably looking to get certain specialized tax rules that you may need professional advice on. But just know that if you end up filing your taxes, including your North Carolina state taxes after April 15th, you won't get penalized as long as it's before May 1. Now, again, that's only about 2 weeks worth of leeway there, but it's still something. Now, North Carolina, on the other hand, did lower their state income tax rate. Unfortunately, not for 2024. And the reason is just because Helene came in and the rate had already been set for 2024. But at least in 2025, it's going to go down by 0.25% and then another roughly 0.25% in 2026. I realized that this is going to be a long rebuild for a lot of y'all, and I wanted to include that. It's not a huge decrease, but at least there's some hope that some of your tax burden is going to go down, at least on the state level, in the future years. And this is just state taxes. We'll talk about property taxes now because somebody expressed some concern that these would be going up in future years. I don't have any answers on that necessarily, but I do have some numbers at the end of this particular section. And so just to give some the concepts of how property taxes work, because that's pretty important in this, is property taxes are assessed at the beginning of the calendar year and then due around the end of that same calendar year. And so in 2024, the way that worked is the property values were assessed on January 1st of 2024. So about 13, 14-ish months ago. And then property taxes were due on January 6, 2025. And a lot of folks were very frustrated by this. If you look up North Carolina property taxes, there was a lot of backlash on property taxes being due just a few months after Helene, especially with the folks being like, hey, you're just up the road from me. What I went through. But most of the counties, their hands were tied at this particular level. And the reason that I wanted to point out the distinction in these dates is, the property values were assessed on January 1st of 24. That was before Helene came through. A lot of property was destroyed in between January 1st, 24 and January 6th, 25. And the property value assessment is not going to take into account the difference in property value due to Helene, at least not for the 24 property taxes, aka the ones that you should have already paid, or if you haven't paid, there's interest accruing on them. The reason county governments, their hands are tied is they're under a mandate from state law. They have to take periodic reappraisals of property's value in order to ensure accurate updates of property's value. Now, these assessments occur every year. I know I put every 4 years, but the reappraisals occur every 4 years, sometimes more frequently. The reappraisals are a little bit more intensive process, but the assessments just essentially take into account how much general property value is increasing year over year. And county governments, again, are under a mandate from state law to make these reappraisals and to take the assessments out every year. All of this is under state law. The counties themselves do not have the power to change much about this. And so this is questions that a lot of counties have been having to answer lately, and I wanted to provide some of it here. And so the first question is can a local government, your county government, extend the delinquency date, aka what was January 6th of this year, for property tax payments to prevent interest accrual or paying more than you would have to? And the answer to that is no, not because the county's trying to stick it to you, but because state law prevents them from being able to do it. I fully support freedom of speech, but in this particular case, if you want to direct a complaint, it would be more accurate to direct that towards your state government, not your county government. And the other answer, because some people would hear this and they would think, well, okay, state law prevents them from changing the delinquency date. Well, maybe they can just reduce the property tax rate. And the fact of the matter is the county under state law is only allowed to do that if they choose to do it before the end of 2024. And that's with respect to the 2024 tax rate. And they, at this point, that date has already passed. We're in 2025. And so local government cannot change their property tax rate after the year is over. And there's questions about, can the county postpone the reappraisal schedule for 2025? And the answer to that is yes, assuming there's a few different factors. And I list these last two questions because a few counties have been trying to take special steps with respect to this. And so there's two different ways that I've seen counties try to take approaches to this. And this is just what I've seen. Your county may have done something and I just didn't see it on the local news that I've been gathering for this. And so Burke County is doing a 1-year assessed property value specifically for the 25 property taxes. So they can't do anything about 24, but in 25, and this is a program I'd highly encourage you to look into if you're in Burke County and you took a lot of property damage. They want you to send in a report outlining the damages, and that way they can decrease your property value for 25 and reduce your property tax burden this time next year minus a few months or a month or two. On the other hand, Haywood County has actually postponed a 2025 property appraisal to 2027. Now, this seems like the opposite approach of what Burke County is doing, but Burke County is changing their assessment dates, whereas Haywood County is changing their reappraisal dates. Now, your assessment dates you would want to be done sooner as a result of Helene because that's individualized. And so you want your individual property values to be lower. But, and this is something that predated Helene significantly, North Carolina property values have been going up significantly. It's when a reappraisal gets done across the entire county, chances are the county taxes are going to go up. And so the reason that Haywood County postponed their reappraisal, which is again different than an assessment, is so that they could avoid the increase that would have happened, or the increase in the taxes that would have happened from the reappraisal. And they did that for 2 years. I believe they could have done it for another 2 years on top of that, and they may end up doing that later. I don't know. I'm not privy to those conversations. But just under state law, I think they could have extended out to 2029 if they wanted to. Under North Carolina law, you're allowed to do a reappraisal as far out as every 8 years. The reason most county governments are hesitant to do that is because, if you're reappraising every 8 years as opposed to every 1 year, every 8 years, whoever's in office at that particular time is going to get a lot of really angry phone calls because your property taxes are going to go up significantly. Whereas it'll do it incrementally if you do it every 1 year or every 2 years or every 4 years, which is the most common. In terms of what you can do for 24, because that's probably what most of you are concerned about as opposed to your 25 taxes, you can contact your local property tax office and talk to them about payment plans for your 24 taxes. Now, this is also the time to be contacting them with respect to damage on your 25 taxes, so that you can lower the valuation for 25. And so again, I know that's not great news for your 24 taxes, aka the ones that you may be having interest accruing on at this point, or ones that you were upset to have paid as much as you did. But I did want to provide some clarity on that because I realized that there were a lot of bitter feelings over this, and I can understand why, because this is sort of the first tax bill you've had to pay. It's the one it's the most local tax that you're likely going to be paying. Folks who you would have thought would have understood, and they certainly do. It's just their hands are tied based on the state laws, and so they're doing what they can, but that their hands are tied based under state laws. And just to wrap up some of the local tax things, again, I attached a link here. This is one of the initial reports that came from, I believe, the governor's office, or the Office of State Budget Management. And this talked about the projected effect of Hurricane Helene on tax revenue. At least it did on page 84. And so state taxes and fee revenue loss is looking at about 135 million, whereas local tax and fee revenue loss is 293 million. Obviously, that's major money. You know, one of the things to be concerned about, at least in the short term, is making sure that you can cash flow out your local property taxes. But one thing to be at least concerned about in the future is, are there going to be increases in your property tax as a result of the significant loss? I mean, y'all basically lost one leaf watching season as a result of this, as well as all the harvest and all the tourism that you would have had up there. And so that's one thing to keep an eye on, at least. And I don't have, these are just projections that I pulled that another economist wrote up, but it's something to keep an eye on, and to, you know, at least be budgeting for in the future. And I can't give more specific answers there, but somebody at least did ask, are my property taxes going to go up because of all this destruction? And at least the demand for that will be there. So definitely something to keep an eye on. The most common question that I've gotten out of all this is, you know, people getting, usually it was the FEMA money, and they would say, hey, am I going to get taxed on this money? Like, a lot of times they didn't even ask for it. Like, they just, you know, it's like a mailbox money sort of situation. And generally speaking, and very broadly speaking at that, a qualified disaster relief payment, which is a defined term under the IRS code, will not be included in your income calculation. AKA, you're not going to get taxed on the FEMA money, assuming that you meet certain criteria, which are pretty broad. And so the definition for a qualified disaster relief payment, it goes to reimburse or pay reasonable. And as long as it meets any of these four criteria, to be clear, it'll meet it. And so as long as you're reimbursing or paying reasonable and necessary personal, family, living, or funeral expenses that resulted from a natural disaster, chances are, if you're on this call, you had some expense of that level. Or if it had something to do with the repair or rehabilitation of your home, or something that was in your home, it's going to qualify. Or if it came from a person engaged in the furnishing of or sale of transportation as a common carrier because of the death of a person or physical injuries, or if it came from the feds or the state or local government or agency in connection with a qualified disaster, which is where the FEMA money is going to at least come in at. But I know some people got money from charities as well. And generally speaking, that should qualify as a qualified disaster relief payment. The next question that came up a lot was insurance proceeds. And I talk about crop insurance, I think, on the next slide, or maybe the slide after this. And so what I'm talking about here is insurance other than crop insurance. And so you can deduct losses to your home, household items, and vehicles if it's caused by a federally declared disaster, unless those losses are fully reimbursed by insurance or other means of reimbursement. And I know insurance, I mean, Helene was such an unprecedented event for y'all. That's probably not the case. But do realize that if insurance did fully cover something, or if you end up, essentially the way this works is if you had a $500,000 piece of property and it was, you know, there was a house on it and there was a barn and everything got destroyed. And the property at this point is only worth $100,000. That $100,000, we call that salvage value. And if you had it, if you received $400,000 in insurance, and it was a few years down the road, and you fully deducted that $400,000 loss in 24, but you received $400,000 in insurance years later. Well, that overlap, you know, if you made up more than what you originally had in the eyes of the IRS, that's going to be taxable as ordinary income. And so definitely keep in mind, you know, what it's worth now, what it was worth before, how much insurance you're getting onto this, because the IRS is going to look at all of this when they're deciding on your ordinary income treatment. And ordinary income rates, obviously when you're talking about things as valuable as reimbursement or insurance on a home or a property or a barn, can get pretty significant pretty quickly. Now, when it comes to crop insurance, the IRS does provide a few specialized rules. And so if you meet the following, you can postpone the recording of some or possibly all of your crop insurance proceeds as income until the year following the damage. And so, we just talked about how property taxes have already hit you if you haven't paid them yet. There's interest accruing on them. This is one of the rules that you have where you can always postpone some income to another year so that you'll pay it in 2026, and hopefully you will have recovered to some extent, at least by then, and be able to have a little bit better cash flow. And so the first requirement for this, like we talked about earlier, is cash method accounting. Chances are you're probably cash method accounting. If you receive those crop insurance proceeds in the same year of the damage. Now, I heard a lot of reports that, it's taking a while to get this money there. It's not unusual for insurance to take a while to pay y'all. This is probably going to be the trickiest part for most people to meet. But if you didn't receive it in the same year of the damage and your cash method accounting, you're going to be accounting this as income for 2025 anyways. So that's what the IRS is trying to hit there. And so it's sort of, half dozen one way, six the other way in that case. If you'd received it on December 30th, that crop insurance money on December 30th of 24, you could have used this rule to push it back. If you received the money on January 2nd of 25, it would have been 2025 income anyways. And the second or the third and final rule is that you can show under normal business practice that you would have included more than 50% of that income from the crop insurance in any tax year following the year the damage occurred. And I wish I could provide more examples on the specific rule, but I am time conscious here. And so there's a link here. There's a group of ag tax professors across the nation. I'm a part of that group. I'm not a significant part of that group at the moment, although I'm doing my best. It's just there's a lot more senior people in there, and they made a presentation about this specific rule, and they have a lot of examples. And this link takes you to that, or an article that shows the illustration of those rules. And so now we're going to move into more livestock related rules, moving from cropland. We'll move back into some other aspects. Now we're into some livestock specific rules with these next two IRC sections. And so the first one we're going to look at is IRC section 451G. And this is another deferral of income rule. And so it's related to the weather related condition of sale of animals, aka you're selling more animals than you would in a normal year because of the weather. And they calculate normal based on what the past 3 years is. And so this is one of those rules. It doesn't benefit new farmers as much, unfortunately. But the IRS has to have some baseline to say, hey, they did in fact sell more animals than normal. The first, there's a few conditions on it. I'll cover the conditions more on the next slide. But you do have to be in a FEMA designated disaster area. This link takes you to the FEMA page where it talks about the list of these designated disaster areas. And so y'all probably know those by heart at this point, but I do include this on there because I've given this presentation to some farmers in Virginia and Tennessee as well. Again, you have to be a cash accounting method, and about 98% of farmers are. Importantly with 451G, because I'm going to show another rule in a couple of slides that doesn't have this, 451G applies to any livestock sold due to the weather-related condition. There's going to be some restrictions on the next rule I talk about. So if you have livestock that was sold due to Helene, it doesn't matter what type of livestock there are, 451G will apply. The benefit of 451G, similar to the crop insurance rule we just talked about, is that you can take the income from those excess animal sales and defer it to the next tax year. And the reason that's important, because if you had just sold a bunch of livestock, in November, October, December of 2024, well, when this May 1st, 2025 deadline comes around, you would be paying the income tax hit on those particular sales, and you've sold them probably at a loss. And you want to make sure that you're deferring that income tax hit out another year so that you can recover a little bit more. And so the requirements for 451G are this. Your principal business has to be farming. And that's a little bit of a broad rule, but what that means in effect is that more than half of your income has to come from farming. Again, this really does cut out new farmers to a certain extent, but that's what the IRS's rule on this is. You have to be a cash accounting method farmer. And again, you have to show that those animals would have been sold in the following year. And so just to provide an illustration on this, and I'll provide you with a website at the end that can show more illustration of this. Say that I normally sell 25 cattle a year. And we know that because in 2021, I sold 24. In 2022, I sold 26. In 2023, I sold 25. And so that averages out to 25 cattle a year, or head of cattle a year. But in 2024, I sold 40, and I was in one of those disaster relief areas, and I meet all the other conditions. Well, I would be able to defer the income of those 15 extra head of cattle to the next year, to 2025, so that I don't get hit with the property tax or the income tax hit until April 15th of 2026. The other requirement is the weather condition that caused the area to be under the federal disaster area has to cause the sale of the livestock. That's not a hard one to show. There's certain situations where 451G gets used with lesser known weather impacts. There's a presentation on the website that I'll show you where they were talking about a drought. I wasn't familiar with where the drought was hitting. I didn't even know that there was a disaster area declared for the drought that the guy was referring to. Everyone knows Hurricane Helene. That's one of the more iconic storms, unfortunately. But fortunately, with respect to this, if you say that you sold livestock in October of 2024, people are going to probably assume automatically that it was related to Hurricane Helene. And so that's not a hard requirement to show. You don't have to, go through a lot of evidence production or record keeping production to demonstrate that last aspect. One thing to note on 451G, and I don't think this applies to Hurricane Helene as much, but one thing to note is the sale can take place before or after the area is declared eligible for disaster relief. The declaration came pretty quick, at least from what I've seen. Maybe there's different opinions on that. From what I can tell, the declaration came pretty quick, and I don't think that should be an issue for most of y'all. The implication behind this rule would be, one, if you sold like the cattle like literally the next day after Helene had hit, which is probably unlikely just because the practical reality of it being that you're not that worried. Like there's probably not anybody looking around to buy cattle the day after the storm hits. But two, if you had known the storm was coming, you could have sold the cattle beforehand, and that's sort of what 451G is talking about. Now, if you sold the cattle, the excess cattle, and I say cattle, I mean livestock. If you sold the excess livestock in January of 2024, we're going to fail to meet this last requirement here because it's not related to the weather condition. But again, that's usually not that hard to meet. So this is our second rule. This is in contrast to 451G. This is IRC 1033E relating to the involuntary conversion. And again, this one does not apply to all livestock. It only applies to draft, breeding, or dairy livestock, specifically within a 2-year replacement period. If you've ever handled, or you've probably read at some point about, or at least heard about, like a real estate 1031 transaction, this is sort of like the storm livestock version of a 1031 real estate transaction. So the criteria for this one, and I put the requirements on the next page, but this is just to walk through the soft aspects of it, is you have to purchase replacement, again, draft, breeding, or dairy livestock, and you have 2 years to do it. It doesn't matter how long the animal that you're replacing was actually held. And you can actually make it 4 years in most of y'all's cases if you were in a federally declared disaster relief area. So it's a 4-year time period for most of y'all. And some of y'all may need that 4 years to fully, put fences back up, to have to repair your land to be able to put a fence back up. And so the benefit of 1033E, because I realize this is kind of abstract and not really connected, is the gain that you realized from the sale of your livestock as a result of Helene can be postponed if those sale proceeds from the livestock that you sold due to Helene are used to purchase replacement livestock. A few quirks on this, and we'll cover in the next slide. But the result of this is your replacement livestock will take on the basis of the sold livestock, which gives you a better capital gains treatment. And so the requirements for this is you need to have evidence of the weather-related condition, and that gets attached on with a statement that's attached to your tax return. You need to have a computation of the amount of gain realized, and you need to have the number and kind of livestock sold, as well as the number and kind of livestock sold that would have been sold under normal business conditions. Because again, this is mainly applying towards livestock that were sold as a result of Helene that otherwise would not have been sold. And so, unlike 451G, it doesn't have to necessarily be as a result, there's no requirement that the weather-related conditions were the cause of the area to be a federally declared disaster area. Again, I don't think that's mainly an issue for most of y'all because the disaster areas were declared pretty broadly. And you can purchase these replacement animals at any point during that replacement period, which again, for most of y'all in the disaster relief areas is going to be up to 4 years. You don't have to go out and immediately buy them, tomorrow, today. You can wait until you repair your land and have it in a good position to actually be able to house those livestock. And the other thing is, especially, inflation's been a really hot topic over the past few years. With animals, especially in the past few months, it's also got to be a more notable issue. You have to buy the same value of animals, not necessarily the same number of animals. What I mean by that is, let's take it to dairy cattle. Let's say you sold 2 head of dairy cattle for $20,000. I'm not a dairy farmer, so I don't know if those numbers are realistic or not. Please don't be too ashamed of me for not knowing those numbers off the top of my head. But let's say you sold 2 dairy cattle in 2024 for $20,000. Let's say that in 3 years you want to conduct the actions necessary to get the benefit from 1033E, and let's say, well, you can only get one head of dairy cattle for $20,000. Well, you don't need to buy 2. You just need to buy $20,000 worth of dairy cattle, and so that might just mean buying 1 cow at that point. And so it's important to try to buy the right amount. You may have to fudge the numbers a little bit, or not fudge the numbers, but be specific when planning this out. Be strategic when planning this out, because if you buy less, you're going to have to go back and amend your 2024 tax return and pay additional tax plus interest. Nobody wants to do that. And if you buy more, you're going to have to take that excess amount and depreciate that on your future tax returns, which is less of a problem, but still, it would be helpful for you, and especially your tax preparer, if that's not you, to buy the same amount. There's an election you have to make between 451G and 1033E. The factors to consider, the second one is going to be an automatic decision for most of you. If you're replacing anything other than draft breeding or dairy animals, you have to use 451G. If you're replacing draft breeding or dairy animals, you have the choice between 1033E and 451G. Now, you can change if you initially choose 451G and you want to go to 1033E. You can change that later on down the road, but you can't do the reverse without getting IRS approval. And so, again, this is one of those decisions. Talk it out with your tax preparer. Talk it out with anyone else who has a business interest in your property, because this is a pretty complex decision, and you need to make certain business decisions, now and in the future to make sure this is carried out properly. And so, moving into casualty loss, and this goes both towards general casualty losses. So, if you lost your home, if you lost a barn, and there's also, these rules apply to Christmas tree farms as well, because I know that's a big part of Western North Carolina. And I saw that in a lot of the FAQs that have been sent to me. And so there's 3 requirements for any casualty loss in order for the IRS to view it as a casualty loss. Shouldn't be a problem for Helene related losses to meet it. It has to be sudden, it has to be unexpected, it has to be unusual. Obviously, Helene was sudden. I've heard stories of people being like, we didn't even know it was coming until about 12 hours out. It was obviously unexpected. I think the last storm we had like this was Hurricane Camille, I believe, which was in the 60s. And has to be unusual, which again, Helene was definitely unusual. Now, there's a distinction between casualty losses for business investment and casualty losses for personal use. And the IRS distinguishes business and investment use from personal use mainly with the expectation of profit. And so if you have an expectation of profit, and I mean a realistic expectation of profit, you know, the IRS will allow you to call it a casualty loss that related to business use or investment. Now, if you didn't have any expectation of profit, if you only meant it for personal use, or if you had timber that you just, you know, you had trees out like on hunting property, and you kept them there for aesthetic purposes, that's gonna be personal use. If you said I had trees out there and I was gonna cut them down for my own, you know, firewood purposes, that's still not really, you know, if you weren't going to be selling the firewood and have a realistic expectation of profit, you know, it's still going to be qualified as personal use. Now, for personal use, the casualty loss formula isn't very good, to put it bluntly. There's some restrictions that were put on from the 2017 Tax Cuts and Jobs Act that further restricted it to only homes, household items, and personal vehicles. And essentially, the math that we get from this isn't going to be very advantageous. But the first caveat is that if it's a item that was in personal use and it was not in a federally declared disaster area, then you get no allowable loss. Now, again, I'm just assuming that with anyone on this call, the items that you lost were probably in one of those federally declared disaster areas. Because again, y'all were just in the heart of the storm. Now, if it was in a federally declared disaster area, you know, the property being in the federally declared disaster area, the formula is this: you have to determine the loss. And so say you lost a home and it was worth, or say you lost a vehicle, like it was worth $50,000. You have to subtract $100, just flat $100. And then you have to subtract 10% of your adjusted gross income. Whatever is left after that point is your deduction. Usually this results in no deduction at all for your personal property losses. This is the reason a lot of people are not able to take out personal deductions, even when their items were in a federal, the personal items were in a federal declared disaster area, because this is not a very friendly rule for taxpayers. Now, the timber rules, and you'll see that this is very similar to the involuntary conversion rules. And when I say timber rules, I'm referring to Christmas trees for the most part. But again, I know there's some timber, like just true timber, traditional timber in North Carolina, but no Christmas tree farming is generally taxed like timber with respect to these rules. And so again, we have casualty loss. It's a business use casualty loss at this point. And so it's not a hobby Christmas tree farm. It's a business Christmas tree farm. So the casualty loss is going to be the lesser of these two things. The first is going to be the decrease in the fair market value loss of the block. When I say block, I mean the damaged area due to the event. And this is by far the more likely one because it's usually the lower, is the adjusted timber basis of the block. When I say that, adjusted basis means this for your Christmas tree farmers out there. That's your cost of your seedling plus any capitalized planting expenses. And so that's any money you spent prepping the ground, fertilizer, pesticides. That's money. And when I say money, I realize that it's mostly you, the farmer, putting in it, and you might not be paying yourself. But funds spent for planting labor and your planting supplies, like those burlap sacks and things like that. And so usually you're going to be taking the adjusted timber basis of the block because that's the lower the amount. And again, you have to take the lower of the two amount. Like we talked about earlier, when you're getting this casualty loss deduction, you have to take out any insurance proceeds as well as any salvage proceeds. And so say you had 10 acres of Christmas trees and it was 90% wiped out. Well, the income that you got for that 10% that was still there is going to be what we'll call your salvage value. And so you never want to take a loss that was bigger than your actual, or a deduction that's bigger than your actual loss, because the IRS will not be very happy with that, and you will end up having to pay having to amend your tax return as a result of this. Now, I'm expecting questions on this, and I don't have slides on it yet, at least. Again, I've been doing my best just to at least be thoroughly acquainted with these rules. But there are people out there who have information on this. Record keeping becomes incredibly important at this point. And not only record keeping, but the ability, if you lost, if you had a shop on your farm property, or if you lost your computers as a result of the storm, the ability to recreate your records so that you can claim these losses and be accurate with it, because the IRS is still going to want proof that these are accurate losses in case an audit gets performed. And with some of these rules, like we talked about, you actually have to have proof of it when you're claiming the deduction. And so do know that there are resources out there about recreating your records, because I realize that may be the biggest hurdle, or at least the first hurdle that most of y'all are facing when trying to claim these sorts of rules. And so there's some frequently asked questions that come up with casualty loss. And so if you had never done a basis calculation on your Christmas trees, or on your business use property, don't fear. You can still do a retroactive basis determination. That's going to take some research. You're going to want a tax professional on that one. Even if I had been doing this for 20 years, I'd still be telling you need to get a tax professional for that one, because that one's going to be one where they need to look at your books, go through your records, and truly be your fiduciary at that point. The next one, and this is one where you should kind of hope this happens, is what happens if your loss deduction exceeds your income, and you may have a net operating loss, often referred to as an NOL. You may be able to carry that forward to future tax years, and that would be advantageous for you. In terms of other things you may want to know, and this goes all the way back to the beginning of this presentation, you may be able to amend a prior year's tax return and use your current year's casualty loss deduction on that prior year's tax return. I realize, you probably, if you're like me, you've got like arrows going back and forth when I say that. Point being is, if your 2023 taxes are still out there due and payable, you may be able to use your 2024 loss here to reduce your tax burden in 2023. Just something to keep in mind, because, again, that May 1, 2025 deadline is coming up. Involuntary conversion, I don't have a ton of information out there on this one, but I do realize it's going to be one people ask about. Involuntary conversion is the IRS's fancy pants way of essentially saying you lost property due to the destruction of the property. And due to factors outside of your control, aka Hurricane Helene, that property converted from a barn into insurance proceeds, or converted from a barn to FEMA payments, or converted from a barn and you use the money from the FEMA payments or the or the insurance and made it a high tunnel. We talked about 1033E earlier. Involuntary conversion rules work very similar. 1033E was called involuntary conversion, but it applies to livestock. The rules on involuntary conversion work very similarly. You're just carrying your basis over from one asset that was taken away from you outside of your control and putting that basis into your new asset that you acquired as a result of the involuntary conversion. Now, we intentionally left a lot of time open for questions. I do believe we're going towards 7:30, Jennifer. I'll give these slides out as soon as I can. I don't know if I can post links in the chat, but I probably can. On there, I have, and this is the very end of the presentation, Farm Law and Tax is an NC State specific resource. Andrew Brannon, who is the law professor, I'm also a law professor, but Andrew Brannon is like the more senior law professor who handles the broader law issues. We post things there all the time. These are just some of the resources. This talks about the taxability, disaster relief. It talks about some of the extensions of IRS and state deadlines. There was an expansion of unemployment benefits. This is NC State specific stuff. I highly encourage y'all to subscribe to this. In a week, so next Monday, I will post this slide and a longer, Word version of this article or of this material so that you can read through it instead of having to listen to my voice for an hour and a half. Rural tax is the group of ag tax professors across the nation, and they have lots of information from anything from weather-related sales of livestock that go into a lot more detail than I provided, including examples. Because again, I know it's pretty hard to follow this stuff when you're just talking about it in the form of rules. They talk about timber disaster and casualty losses. They talk about the taxation of insurance proceeds. I used a lot of their information creating this because, you know, they had the common questions that get asked. But they're a great resource too, and I'd highly recommend their materials. But again, you know, I'm the tax extension professor in North Carolina. Please contact me if all else fails, or even as your first step, if you would just prefer to, shoot me an email. I do have an office number, but I'm rarely in the office. I'm on the road a lot. I'm not in the office right now. And so if you shoot me an email, I'll get to you as soon as I can and try to answer your questions. And if you have a question, chances are somebody else has the same question. And so with that, I'll open the floor. I really appreciate y'all coming. And hopefully I've been of some help.
Awesome. Thanks, Nick. We really appreciate you streaming in tonight to cover what is a pretty confusing topic for most folks. So we've got some notes of thanks in the chat, and there were a couple questions that came in. So the first one from Natalie, her question is, what about equipment purchased with grant money to replace flooded equipment? Is that deductible as expenses, or does it have to be assets?
So that's going to be one question I'll put in the article because I want to be able to provide a more specific answer on it. But I would think that this would go back to the rules on scroll through here. The taxability of disaster relief payments, because if you're getting money from a grant that's related to the disaster, it shouldn't be taxable. If it's not, then it's going to be related to your involuntary conversion rules. But this would be the first thing that I would look towards, is making sure that it applies towards these qualified disaster relief payments. And if it does, then you can use that money, you know, towards replacing the things that you lost as a result of the storm.
And they are not taxable, right?
Correct. This would be, yeah, this would be a non-taxable source of income.
Okay. It looks like Natalie said in the chat they received a 1099 for this grant payment.
Yeah, and so that's the yeah, and that goes into the if they received a 1099, then I would lean towards looking at those involuntary conversion rules. And Natalie, you've got my email on there, so shoot me an email so that I can answer that question more thoroughly in the article that I'm going to write up, because I know y'all aren't going to be the only ones experiencing that. But at the very least, you would be able to get the involuntary conversion rules and hopefully postpone the tax rules on that, or postpone the tax hit.
Yeah.
Thank you for the question, Natalie.
Yeah, and Laura just put something good in the chat as well. Empowering Mountain Food Systems did give out some supply-related grants in response to Helene, and so we did not send W-9s or 1099s for those. So
yeah, and to clarify this, because I'm glad Laura brought this up, if you did get a 1099, then just assume by default it's going to be taxable, or at least the IRS is going to view it as taxable, and it's best to try to meet that head on with those involuntary conversion rules.
Okay. We've got another question here from Hannah, who says, what about the similar slide? What about the taxability of funds received from GoFundMe? This was set up as a donation to a business who lost crops.
Yeah, so generally speaking, money received via GoFundMe would not be taxable because it's going to be treated like a gift. Now, again, if somebody sends you a 1099 or other related tax paperwork saying that we intended this as like payment, then yeah, then you would have to be sorting that as tax treatment. But you know, I was listening to things on the way here. It's not unusual for businesses to put up GoFundMes for things like this. And generally speaking, those GoFundMes are being treated as non-taxable. They're being treated as a gift. The caveat being, and I'm assuming this is probably the case, But just to clear this up in case somebody is trying to repay the people we put them in that position. If you said donate towards this GoFundMe, and in exchange, we'll send you a Christmas wreath, or we'll send you, we'll send you anything, like basically it looks like if you donate, I'll give you money, or I'll give you something in return, or do services in return. At that point, it might be considered income by the IRS. But if it was truly somebody saying, out of the goodness of my heart, I'm going to give you something, they won't be taxable at that point. It will be like a gift.
Got it. I didn't know that about GoFundMe's, so I learned something new. Those are the only questions that we had in the chat. I'd invite anybody on the call if you've got any other burning questions. Maybe you've got a really specific scenario at your farm. If you want to drop that into the chat, just give people a few minutes to do that.
Yeah, those were good questions, because I know the GoFundMe one. I knew that. I mean, I donated towards the GoFundMe, and I don't say that to advertise towards myself, but like they were, social media was rife with those, which is, of all the problems we have in our world, at least we had that going for us. And so hopefully those saved at least a few people, or helped.
Every little bit helps, I think.
Yeah. And it's, I like, can you hear me, Jennifer? I can't see myself anymore.
Yeah, I can hear you. I can't see you.
Okay. I just wanted to take a moment to let y'all know that Nick mentioned Andrew Brannon. He is going to do an insurance talk for us on March 12th. And so, taxes and insurance are things that you want, the folks who know what they're talking about to talk about. So obviously Nicholas knows what he's talking about. Nick, thank you so much. You did such a great job I was like, wow, it takes a special kind of mind to want to learn this stuff so well. So we're grateful. But Andrew is really interested in this, and as Nick said, has a lot of experience and a lot of love for Western North Carolina. And so Andrew, the attorney, will be here March 12th at the Buncombe County Extension Office in person. But people can also register online for that. So, and that's discussing insurance issues, as we know so many of you have after this storm. So we will be able to, I'm going to get to that question for sure, Lisa. We will be able to record that session as well. We will have your emails from this that Dwayne will supply to us. So we're going to send you an evaluation, and it's so important that you fill that out, and will also help us understand what else y'all need, what are the programs that we can bring to you. So now let me see if I can get into the chat for that question. Is there anything that will help with usage of equipment and putting the farm back together, such as track hoe, tractor, lots of hours on equipment? So are you saying, Lisa, for the rental cost for that? I'm not clear. I think you're saying rental.
I'm going to give Lisa a second reply to that, but I'll plug Andrew Brannon in two particular parts. He's one of my mentors in NC State, so I definitely, most of y'all probably know who he is. I'm the lesser of the two, both in terms of popularity and early prominence and legal acumen. But Andrew Brannon has a lot of resources on present use valuation. I know that's come up a lot with respect to some of these Hurricane Helene issues, as well as sales tax. And so, most people look at me and they're like, you're a tax professor, you must know all the taxes. And I regret to inform you that I don't know all the taxes. In fact, with the sales tax, while I prioritize certain things like storm relief, Brandon actually knows the sales tax rules way more thoroughly than I do. And so if you're looking to pivot your farm and you're trying to, look to provide other niche items in the meantime, your sales tax rules may change as a result of that. And Brandon is a great resource for those sorts of things. And so don't think that just because he's not the tax professor that he doesn't know about certain tax things, because he knows a lot more about sales tax than I do. And it's going to take me a while to catch up with him, to be frank.
Lisa, I tried to unmute you so that you could ask your question. Can you
Sounds like
try
maybe
to?
depreciation. I don't know.
It's
Look,
something about using her equipment, but Daphne, I don't know if you're still here or not. If you could help us unmute somebody. So disable mic. Um, the mic isn't working. So yeah, I just tried to unmute you. I said allow mic, but yeah. So Lisa, I'm sorry, I'm just not clear on that question. I will read what you wrote. You said, is there anything that will help with usage of equipment and putting the farm back together, such as track hoe tractor? Lots of hours on the equipment. We own the equipment and use it for another business. So I don't know. I think maybe she's saying, can can the farm reimburse her business for using her business tractors for repair? But I could be wrong. So Lisa, I think you might want to take Nick up on his offer and email him directly.
And I'll bug everyone else with a quick scroll of the slides there. But Lisa, definitely send me an email, and I can give you, my cell phone number, and we can call if that's easier too. Because I'm not tracking that question either, but I definitely want to help you with it. And so, because I think that's going to be one of those things where it depends on who owns what and how it's being used. I think Jennifer may be on the right page with some of the tracks that she had too.
Yeah, and that's one of the sessions that Jennifer is teaching for us in this project is, what is the best legal structure for your business for your farm? And that probably gets into this kind of thing, that if the two businesses are separate, one can serve the other.
Yeah, that's
So
definitely
S Corp, LLC, all those considerations that folks don't think about until this awful thing happens. So,
I think that
yeah.
also gets into the record keeping that Nick mentioned. But I know, at least if it were me and I had two businesses that were really similar like that, it would be easy just to move the equipment around and use it where you need it. But you may consider like you invoicing from the primary business that owns the track hoe to the farm to show that
Mhm.
use of equipment. And to show that increased expense for this year.
And let me speak to, while we're plugging other NC State folks, Andrew Brandon's the other law professor. Derek Washburn is our record keeping guy. And one of the measures of a great extension professor is how little somebody is in their office. And Derek seems like he's always on the road and going and talking to folks. And so if you can look up Derek Washburn, wash is like wash yourself, and then burn is in just like BURN. He would be a great resource in terms of being able to recreate records. I can point you towards some other resources towards recreating records too, but he tends to be our record keeping guy too. Especially when it comes to, if you need, the distinction I would make is if you need something without recreating your records, probably email me and I'll get in contact with the people that I know about that. If you just need general record keeping stuff, Derek's definitely your guy.
Things that we're really trying to do is bring NC State resources to Western North Carolina. Probably the folks on this session understand that there's a lot of resources that are not out here historically. And so the NC State Empowering Mountain Food Systems Project is trying to remedy that and bring our talent out here. And Nick, thank you for being part of that tonight. We really appreciate you being willing to do this and coming to the region. Nick is going to actually be speaking at the Organic Grower School March 14th. So the same session, and I think, as you can tell, he keeps getting more information. And what I appreciate is he's getting more information from other professors, but also from farmers. He's really gathering this information. So if y'all are going to the Organic Grower School, which I hope you are, you can meet us all there. All three of us will be there So thanks so much. But I think is there anything left in the chat? I think folks are just saying thank you and taking off. Jennifer posted the feedback form in there. It is super, super important to us. Our funders pay attention to how we're doing, and it helps us with our programming. But we will also email it to you. So with that, if there's nothing else, we can take off. But thank you again, Nick, for
Thank y'all
being
so much. I really
here.
appreciate everybody coming, and Jennifer and Laura and Dwayne for putting this on. And Daphne too.
Right. Well, thanks everybody. Take care. Fill out the survey. You'll also get an email from us. And we hope to see you in person soon. And we certainly wish you the best in your rebuilding.
Thanks, y'all.
Good night. Okay, I'm going to stop recording. Doo, 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 doo.